The market is getting very spooked by what's going on in Italy, and we know that the most recent news is that Ray Dalio and Bridgewater has shorted Italy, all across the board, banks and other companies now as well.
Well, Hank, you have a very difficult election coming up in March next month because it looks like Berlusconi may come back, with his arrangement that he has with the Northern League, and then Five Star Movement also, with the polls, seems to be leading by a slight number, and the Democratic Party seems to be in real trouble. So it's not clear what's going to happen, but there's a lot of anti-Euro feeling within the country, and then immigration is a big, big issue because of the hundreds of thousands that have come in from Northern Africa. So it's a very unsettled situation, and the economy, although it's looking better this year than the last few years, is still not great. And the one country, I think it's fair to say, in the Eurozone, which is not doing better than it was before it entered the Eurozone, is Italy.
Exactly. Now, could there be contagion? Because if you take a look at chart 9330, you can see that just in the last few days alone, Italian assets have begun wavering even more. The 10-year yield spread to Germany's 10-year yield is obviously wider, and the FTSE MIB is lower than it was. Is there a possibility of contagion from this election, from this geopolitical risk? Or are we seeing the last of the European countries' geopolitical risks sort of get sorted out now?
Well, one other, before I answer that, let me just mention that the Italian banking system, which has made some progress over the last year and a half, still has major problems with the non-performing. So I think that in addition to anything else with the mix, you have high unemployment, you have a banking system that's very fragile in the country. And if you have a sort of a situation where the election is not clear who the winners are, and they try and put together a coalition government that doesn't function, then you could have real problems, perhaps in spreading, a difficult scenario. Because let's remember, Germany has its own problems today, and they were the leader in the sense of the weakness in both of the parties in the coalition. The one bright spot, I would say, in the Eurozone today, apart from your native Ireland, is France because of Macron. And that, to me, is the guiding light of what can happen. Italy is the dark side of it, the downside, if this election does not come out with a clear winner. And there is a possibility they could even call a referendum. In other words, an Italian Brexit. Always a possibility, depending on which party wins.
Wow, an Italian Brexit, that no doubt would send jitters through the markets, Bill. And speaking of jitters through the markets, you very presciently in January of this year said that these markets, equity markets, were due a correction. And in the past week or so, of course, we've had this sell-off that a number of people have called a healthy correction, said it's time to buy the dip. I just want to show you a chart. It's G#BTV6789. And what it shows is that although we've had this sell-off, the current drawdown is painful but normal. It's happened loads of times. My question to you is, has the sell-off gone far enough to actually be classified as healthy in the sense that we get a reassessment of portfolios, a reassessment of risk, of asset correlations? Or are we at a point where this needs to go further before the markets can sort of recalibrate?
I think that's a key question. And even if we see the markets coming back at this particular point in time, I still think we could face another problem later on in the year, because as inflation starts moving up, as we've seen by the figures today in the CPI, and you have all of this stimulus by this tax package put into the market plus the budget, I think the Fed will be forced to raise interest rates 4 times, and even possible that they could accelerate the takedown of quantitative easing from what they have. So I think the markets are very jittery. I think you're going to find a lot of volatility throughout the course of this year, something we haven't had in the last few years, because we've had such a tremendous search and reach for yield with this accommodation. And so this period over the last 8-9 years, I call the Great Accommodation, with all the major central banks of the world pushing money into the system, and has led this tremendous search and reach for yield. And the question is now, with this added stimulus in the United States, is this going to cause us a greater problem going forward? So even though we may come back from this present adjustment, correction. Not clear to me that we won't have another one before the end of the year. That's why I predicted a 10 to 20% correction